Our next guest is the founder of Mott Capital Management, Michael Kramer, who for a couple of months now has remained stern in his narrative that the Fed will not reduce rates anytime soon and that inflation is not over yet. Michael, you've been consistent with your calls of caution, and you're right. So I commend you for that. Congratulations, my man. Thank you for being here today.
Thanks for having me again. Glad we can do this.
So this week saw another big shift in the market narrative, right? As inflation concerns took a backseat to the banking crisis. In response, we saw the US dollar retreat, the Treasury yields plunge. Now, that's surprising a bit to me because that bond market is possibly pricing in rate cuts. Is that just mechanical, or can we see yields start to rise again post the Fed?
So I think it started as a flight to safety. If you remember that morning, we were doing the live spaces when the job report came out. And as that was coming out, 5 minutes later, as we were dissecting the market, Silicon Valley stock was halted after a failed attempt to do a capital raise. And that sort of led to a flight to safety, which really sort of unwound and started this whole short covering episode within the Treasury complex and in yields in general, which really sort of exacerbated the move, which gives the impression that the Fed is going to start cutting rates rather aggressively. I still tend to think that you're going to see the Fed hike rates tomorrow by 25 basis points and probably indicate no rate cuts in 2023 and potentially even a higher terminal rate.
So more into the FOMC meeting tomorrow, let's revisit our facts, some of which you mentioned. There was a fall in U.S. inflation, PPI, and retail sales. U.S. CPI data released showed another fall in annualized rate from 6.4% as expected. This suggests a cooling U.S. economy in a way. But we also saw U.S. stock markets rally. They're still in that phase at the moment. So just to add to that, the banking crisis going on right now, it doesn't seem that the government will allow a systemic problem to unfold like 2008. But you just mentioned that they'll probably go by 25 basis points. But do you think they'll point out to a near-term pause or maybe even start slowing rates closer than what we expected initially?
I think they're going to continue to lean on data dependency and indicate that, no rate cuts in 2023. And I think they're going to still show a higher terminal rate. I think the Fed has evolved a lot since 2008. I think the narrative that many people are sort of focusing on is the 2008 playbook, which I think is just incorrect at this point. Mm-hmm. First of all, we all know 2008 didn't happen in one day. It took 2007 started the whole thing, and it rolled into 2008. And it really wasn't until the failure of Lehman, which they later realized was a tremendous mistake, that really things started to unwind. And really with that whole episode, having lived through it, it really had a lot to do with bad loans and loans on books not, being solid, with, mortgage-backed securities imploding, with not knowing how to mark to market certain derivative assets. And then, of course, there's a whole, entanglement that comes with it, the counterparty risk and whatnot. In this case, you're talking about something a little bit different because Silicon Valley Bank, it was just a matter of how they were sort of hedging their books with the long-term duration of treasuries that they were holding. And it started with, a downgrade from what I understand of Moody's. And then, of course, they had a Fed capital raise, which sort of led into all of this. And it just seems like a different scenario. Additionally, you're seeing the Fed act much more aggressively today than they did in 2008. You're seeing, this new bank lending facility. You're seeing use of the discount window. The Fed has a much larger reserve, much larger balance sheet. Banks have over $3 trillion in reserves on that balance sheet. I just think it's very different. Even with the Credit Suisse episode and with UBS taking it over, the ECB, comes out and still raises rates last week. The Credit Suisse issue was well known going into that meeting. And the Fed immediately opened up swap lines to make sure that there was no pressure on the dollar funding market. So it seems to me like the Fed is trying to handle this episode with the banking issue, at least dealing more with the balance sheet side of the equation and using liquidity to make sure that the system stays afloat. On top of that, you have the Treasury acting very aggressively to try to ensure deposits. And so I just think that this is a very different scenario than what was unfolding in 2008. You're not seeing loans at this point sort of blowing up and all sorts of risky derivatives on people's books that are just, not being marked to market correctly.
Right, and it's interesting how major U.S. indices have been doing well. You see this huge push and rally in tech stocks, particularly. So, if you don't mind, walk me through what you're seeing on the charts. A lot can be said from what could potentially happen next from a technical perspective.
So the whole rally in tech has been twofold. There's been a flight to safety, and then there's been the relationship between the TIP and the QQQ ETF that we've maintained now for some time. And basically, the TIP ETF is a representation of real yields. When real yields are rising, that's bad for technology, that's bad for NASDAQ stocks. When the TIP ETF is falling, it's a positive for the NASDAQ, and it's a positive for the overall technology sector. So in this case, you've had the TIP ETF, which has been rising, a sign of rising real yields, and that's benefited tech. The question is the TIP ETF going to continue to rise, or is it going to begin to fall, meaning that real yields are going to start going back up again? If you're in the camp that the Fed is going to continue to keep rates up this year, then you have to believe that real yields are going to come back, are going to go back up, and the TIP ETF is going to head lower. And so when you just look at this comparison, you can see there's again been a little bit of a separation between the two. They had started to come together again, and now they're starting to separate. So we'll just have to kind of wait and see how that develops. Again, once we have the Fed meeting, we should have a lot more clarity in terms of how that relationship is going to work. Just in terms of the QQQ in general, you can see here that we briefly broke below the uptrend, came back up right now, and we're sort of in an area where you could start defining a double top pattern. I know that some people have tried to identify this as a triple bottom. I just don't see it that way. And so right now, the key level here for the Qs is going to be whether or not you can pass this zone around 310 to 312, because if you can pass it, then you have a clear breakout. If you stall around this 310 to 312 area, you could be looking at a double top pattern forming here with a retest of the lows coming. And that's going to largely depend on which way rates are going to go.
Yeah, understood. And, if we look at the S&P and the Dow Jones, I think the general consensus is they're currently trading in a sideways fashion, and they may continue to do so. What's your take on those two?
So the Dow, the last time we talked, we were talking about the diamond pattern, which clearly played out to some degree. Diamond pattern, if it was could actually play all the way to completion, could actually take us back to the lows. Right now, though, we have, what looks to be a little bit of a short-term bounce. Again, the Dow is a very heavily, financial sort of related indice or average. And so if you're a believer that financials are going to struggle, the Dow should struggle as well. But right now, if we look at the Dow more on an hourly chart, you can get a little bit of a sense that maybe there's a little bit more upside before it ultimately reverses. You can see there's a what looks to be an inverse head and shoulders pattern that's formed here. And if this plays out to completion with the neckline right here, if this plays out to completion, I mean, it could suggest that maybe the Dow has a little bit further to climb, maybe back towards this 33,100 area before it ultimately maybe turns lower again. The S&P 500 clearly broke the downtrend, the uptrend here, and it's able today at least to gap higher and gap back above it, which is sort of again a little confusing. Is this a real breakout, or is this just sort of a fake out before another move down? And that's really the key question here is. Because you could actually rally all the way back to 4,020, 4,030 or so before you really would have any real clue as to whether there's further upside potential or not. To this point, I mean, I think trying to figure out whether you're going to get another, call it 20 to 40 points on the S&P versus, downside risk, it may not even be worth sort of considering right now.
Got it. And, if we do close the week higher than where the markets are trading right now in that range, especially with the S&P, assuming a dovish Fed, of course, can we start to see the bears lose their grip, or are we still back to that conversation of bulls versus bears? Anybody could take it.
Clearly, if the Fed does indicate that they're going to pause or gives a dovish hike, where they signal, no increases coming and just sort of a pause after this rate hike. I mean, you could certainly see animal spirits take over again and the bulls sort of grab grab control of the market, it would certainly put 4,200, maybe 4,300 even into play. But again, until you get to that bridge, it's really hard to call that one. And so, I mean, I think, again, based off of things the Fed has said in the past and the way that the governors and board members have spoken at meetings and conferences and such, I'm still sort of leaning my hat on this idea that the Fed is probably going to continue to go about its policy hikes and leave the liquidity issues to the balance sheet.
Got it. I want to quickly also talk about the Bank of England's decision. Let's not leave that behind. It's on Thursday. So last month they signaled it might finally be done with tightening, or at least that it was close. Are we expecting a base case for 25 basis points, or maybe leaning more in favor of a hold?
So if we just take a look at how the market's pricing this, there's only like a 50% chance of a rate hike. So you're talking about a coin flip at this point in terms of how the market's thinking about it. And so, I mean, it's a really close call. If they're concerned, like they're probably going to take their lead from the Fed, right? Because if the Fed goes 25, it's probably going to put the pressure on them to also go. Because again, you had the ECB raise 50, then you have the Fed come out and raise 50. And, it's going to be kind of tough for them not to go 25, right? If the Fed doesn't do anything, then it probably makes it easier for them to pause as well. So I think you're just going to kind of have to wait and see what the Fed does here. If the Fed goes 25, I think the BOE will probably go 25 as well.
Yeah, right. And we've seen the pound perform better than the euro during the recent turbulence in the banking sector, despite having a generally higher beta to risk sentiment. But market conditions suggest that a decision on Thursday, whichever it may go, might not be enough to trigger a pound rally. But also, if they decide not to hike at all, you could actually see the sterling lower or trade lower into the end of the week. What's your take on the currency pair? And do you think we can test the January highs of 1.24?
So the pound, interestingly, is right in the middle of the trading range that we've been following now, basically going back to the middle of November. You can see very clearly between 118 and 124, 125 has been the range. Tested it 2 times to the top, tested it 2 times to the bottom. So it's almost like the bond, the currency market is just as torn as the fixed income market in terms of what it thinks the BOE is going to do. Clearly, at this point, very hard to tell. I mean, if you just base it off purely on momentum indicators and which way the momentum is sort of leaning right now, I mean, you can see that there is a downtrend that's formed on the short-term RSI, which could be suggestive that the momentum is still heading lower for the overall British pound. And of course, if you get a 25 hike out of the Fed and then nothing from the BOE, that's going to be purely a sign for the pound to devalue against the dollar.
Not long ago, we were looking at the FTSE 100. We were quite surprised it was almost hitting, or did hit, an all-time high in these conditions. What's your take on it now? What's next for it?
So it fell very sharply. Obviously, the FTSE is very, financial heavy. We talked about how it was sort of following Hong Kong higher. It was sort of following, the Dow and the Australia 200 higher as well. And those markets have turned rather considerably lower. Hang Seng has been one of them that has fallen quite materially. And so it's not surprising to see the FTSE sort of rolling over as well. It looks like at this point it's probably oversold. The RSI is down below 30. You can see it's gotten a pretty sharp rebound at this point. If we look at it from just a purely a retracement standpoint, you can see it's a 62% retracement off of this low. So this is an area that probably carries a lot of weight to hold, this 7,000 to 7,300 region. If that holds, then you can probably get a nice rebound, at least back up to 7,700 in the near term.
I'll certainly be by my screens watching what the Fed and the Bank of England do, but thank you for wading into all of that. It's good to see you again, Michael. It's always a pleasure to have you on.
Thank you for having me. Great to see you too.